Hello and welcome to the Global View on this Thursday. Well, US Treasury yields were mixed ahead of the auction of $40 billion of 10-year Treasury notes and on renewed concern about a possible US recession. The 10-year yield was down to 4.54% and has fallen around 40 basis points since the Fed's monetary policy meeting last week. The 2-year yield at 4.93%. And the US dollar has gained for a third straight session as investors look for clarity over the Fed's stance on interest rates, with Chairman Jerome Powell due to speak tomorrow. The Aussie dollar, having lost around 0.5% overnight, it's currently trading at 64 US cents. Now on the data docket, US wholesale trade sales rose 2.2% in September, well above expectations, and the largest rise since January last year, with petroleum being the biggest contributor. Meanwhile, Bank of England Governor Andrew Bailey has said it's too early for rate cut talks, saying that while inflation will fall sharply in coming months thanks to base effects from energy prices, monetary policy needs to remain restrictive for an extended period of time. Well, in financial systems, cracks typically begin on the periphery and then expand to the centre. That is the view of Arthur Budaghyan from BCA Research, who's concerned about an impending global economic downturn.
I think global manufacturing has been contracting for one more year. However, U.S. consumers still have been resilient. Europe heading into recession, so that leaves U.S. consumer the last shoe to drop. As U.S. consumers kind of start cracking or weakening, I think we'll have a full-fledged global economic downturn.
Oh, so you're seeing then cracks emerge in financial systems at the moment, are you?
Yes, if we look at S&P, we'll see S&P has done really well this year. However, when we look outside S&P, beyond S&P, we'll see that everywhere we'll see cracks. In fact, in any financial system, cracks appear on edges, on periphery, then spread to the center core being S&P 500. So S&P will be last being affected. But if we look at US small, mid cap, US micro cap, they have been plunging. If you look at global stocks, ex-US, they have been extremely weak. Emerging markets, they have been quite weak. And Korean KOSPI, which is a barometer of global growth, until rebound early this week, due to some regulatory changes, has been signaling that global trade, global downturn is about to unfold.
So, I mean, you mentioned there in particular emerging markets. Where are you seeing the most concern there, particularly, I guess, maybe in Asia?
No, I think emerging markets, you can see very poor performance across the board, starting with Chinese stocks that have been doing quite poorly, indicating that Chinese economy is not recovering despite reopening this year. Then we'll look to the rest of Asia, whether it's Korea, Taiwan, or ASEAN markets, Southeast Asia. All of them outside of India have been extremely weak. Even in absolute terms, they have been basically in some sort of a bear market. And then we'll look to Latin America. They have been quite strong, resilient till August. But since August, Latin American markets have also been on a weaker side. So it's a quite broad-based weakness across emerging markets. And the weakness in industrial commodities is confirming that global growth is quite weak.
So overall, you're seeing a manufacturing recession gather pace then, are you?
In fact, manufacturing recession has been taking place since mid-2022. I think what we're looking at right now, manufacturing recession continuing, and some strong areas like US consumers weakening to, in that case, will move from a rotational recession in some part of the world to broader, more full-fledged global growth downturn.
How is this playing out, I guess, particularly with US treasuries and also the US dollar?
Global manufacturing downturn or global downturn in general is a positive for US dollar. Why? Because US dollar is a counter-cyclical currency. When a global growth is disappointing, US dollar typically up, even if it's US growth that is epicenter of a disappointment. But one thing to keep in mind, and very important, I think as global downturn unfolds, US economy is going to be the last one to enter the downturn because of resilient U.S. consumers. So in fact, U.S. will be lagging in this downturn, and that's why U.S. dollar will be on a stronger footing in coming months going forward. As U.S. Treasuries, I believe U.S. Treasury sell-off in late stages. I'm not sure we have seen a kind of an ultimate buying point, but I think before end of this quarter, before end of the year, we'll see a major buying opportunity in U.S. Treasury yields, bonds.
So you talk about the US downturn as well. Are you expecting then that is going to move into recession?
Probably GDP will be close to zero or slightly negative. I'm not looking at a very hard landing in U.S. real economy, but I think financial markets will have a meaningful sell-off. So there's no excesses in U.S. economy, but a recession most likely to happen in 2024. And how I would characterize recession: unemployment rate rising. As unemployment rate rise, consumer will be cutting spending, and U.S. financial market risk assets globally are still vulnerable to downside. Whether it will be zero real growth or minus 1% real growth, I don't know, but I think we are going to experience recession type of a downturn in U.S.
So Arthur, if your projections come to pass then, what is the expectation that you have for the response from central banks?
Eventually, central banks will be easing. However, bar for easing, it's much higher this time than in the past. Why? Because inflation in past 25 plus years, inflation has always been under 2%, under target. And any small downturn in economy, Fed or ECB were kind of a quick to respond and ease. This time, core inflation still well above target, even though it's falling and might eventually go to target, but above target inflation will make sure that central banks in US and Europe and any part of the world are going to be hesitant, and they will be reactive, not proactive in cutting interest rate. That's why I believe this US recession, even though it's not going to be hard one, is not going to deep one, I think is going to be a bit lasting longer. So it's a milder, shallow, but longer type of a downturn, what I expect going forward.
Futures market pricing in a more than 50% chance now that the Fed will begin cutting by May. Is that realistic, do you think?
Yes, it's possible, but economy should be in recession by that. S&P should be much lower than that. Global risk assets should be much lower. I don't see U.S. bond yields rising and global risk assets rallying too. So I expect at some point falling U.S. bond yields need not be enough to bail out global risk assets. In that scenario, yes, Fed will be cutting, but it might not be positive for risk assets going into that before that.
So overall then, Arthur, I'm gathering that you have a broader negative outlook on equities.
Yes, I think global equities and global risk assets are quite vulnerable at this point. Last few days we have seen quite a strong rebound, but I believe it's a rebound in a genuine downturn.
So, given that then, how should investors be positioning themselves?
I think from a asset allocation perspective, starting to favor bonds, fixed income over equities, it's a kind of sensible asset allocation decision. If you look at global stocks have been outperforming bonds in the past several years, but I think turning point in a stock to bond allocation has come, and bonds will outperform equities going forward. And for absolute return investors staying on sidelines, defensive or in cash, it's probably the best investment strategy going forward.
And with your outlook for the US dollar retaining its strength for some time to come then, does that mean perhaps you're a little more negative as far as gold is concerned, given its recent rally?
Short term, yes, but I think in a long term there is a structural tailwind for gold prices. So I would say yes, in short term, as dollar rebounds, gold and other commodities are vulnerable, but gold is still has a structural tailwind that will support it beyond near term.
Arthur Budaghyan from BCA Research. All right, that is the global view. We are expecting to open higher this morning. There you can see ASX futures up 1/3%. Stay with us. The open just around the corner.